Cashflow Chronicles. Chris might be joining us. I sent him the link a little late, so you guys can blame me on that one. Today, we're going to have a hell of an episode. I listened to both the Disney as well as the Rklb earning calls, and so very excited to kind of talk on both of those opportunities. I saw that Vince and Arnie were able to do the live stream for Rklb earlier today. Unfortunately, I was in a meeting and I couldn't live stream it for you guys, but had a good opportunity to listen to it on the drive home, the conference call on the ride home, as well as look through the numbers. And I will say there was definitely a tone change with respect to moving from if and you know the thought process of we'll kind of get to the Neutron aspect of things to really starting to look forward to delivering a Neutron medium launch rocket for Rklb, and then also continued performance when it came to Disney and Disney Plus subscribers. Cash flow from operations not observed from Disney since pre-pandemic, before Disney Plus was launched. So we will go big into both opportunities. And if Chris joins us, we'll have some good banter. If not, then I'll be able to listen to you guys and hopefully answer any sort of questions, dive deep, talk a little bit about both of these earning reports. And then also when Chris gets here, I also want to talk about what are we going to be talking about tomorrow? I was doing some research on a few other companies that I know are completely blowing up, looking at other earnings reports, Celsius being one, over 100% year-over-year growth, which is impressive. And I was looking at some of the numbers. If it continues that sort of pace, it's looking pretty cheap. Is that a company we want to talk about? I know Chris also was bringing up a few others, Hood and SoFi. I've never talked about either of those really much on the channel. Hi, Chris. What on?
I was in bed with the producer wife, and then I was like, rushing to get here. And I was like, where's the link? And then I saw
that was my fault. It was a little late, so apologies on that one. Just talking about Disney and the return back to good earnings that haven't been seen since pre-pandemic. The Disney Plus increased subscribers. I'm looking at the all the different price increases that they had in the background here, which we can get into. But really, and I'll talk a lot about Rocket.
The price increases haven't even come in yet. Remember, they only went live this month.
You're coming in a little choppy. I don't know. It's like I can hear every word, but it's like coming in and out. The thing that I'm excited about with Disney is getting, and we'll touch on it as well, like the closeness to break even for Disney Plus. So I think that's going to do really, really well as well. And then I wanted to ask you, we have an open day tomorrow. I wanted to get your thoughts about what companies haven't we talked about on the channel that you're kind of scoping out. I want to preface this not just with Celsius, because I looked at Celsius, the earnings report was fucking phenomenal. And I actually was looking at the price that Celsius is at compared to where they are in North America market and also the international market. The international market's barely touched. So I'm like, oh shit, like there's a big opportunity with Celsius going abroad if they're able to match Red Bull, Raj Monster, stuff like that. So I want to potentially open that up for comment tomorrow. And then for me, I've gotten to a place now. You kind of know what my speculative nature is. I like to find things that are a little bit before profitability to just getting to cash flow break even, to that point where it's like it's risky, but there's a turning point. If it doesn't really start meeting thresholds, you have like an exit ramp to some sort of extent, but they're getting closer and closer to profitability. I did the same thing with Palantir, Rklb, and I'm looking for that next opportunity. And I have some things in the portfolio that are very small and stuff of the like, but I'm curious what Hot Chris the Daisy God is sitting here being like, ooh, this is something that I want to hold long term for, let's just say, decades to come, or I want to see this to fruition, rather than those quick swing trades that sometimes I know you might take on in the swing portfolio.
Carnival Cruise Lines.
Ooh, I haven't looked at that in months and quarters. So that would be cool to look at.
Yeah, Carnival is in a multi-year transformation to kind of like flip the script, finally start to delever, and they're just hit operating income positive again. So that means that they're getting back to their profitable nature. This company was paying dividends, was doing really well. If you know the cruise line business, it's a very attractive business cash flow wise, but they took on a lot of debt. So if you look at their valuation, it looks very poor right now. So
now I have a question.
Mm-hmm.
All cruise lines, or is it just Carnival that you're looking at?
I'm looking at primarily Carnival because the valuation of Carnival is probably the most
Norwegian
attractive.
always traded more at a premium. I know that, and then I'm not sure what RCL
Royal
is
Caribbean
trading at.
Royal Caribbean also traded at a significant premium. So
Did it?
Royal
Okay.
Caribbean, in terms of quality of like cruises, is probably the best. Their management is probably the best. The play on Carnival, however, is around recovery. You know, that's the key that I would say. The other thing is they issued a lot of shares during the whole COVID thing. So that has basically depressed their stock price a lot. But once again, you know, you get back to deleveraging, you get the optionality to use that additional cash flow for other things like share buybacks. And then eventually you get to a point where the profit just starts to grow, and your EPS starts to grow. And then you eventually do amazing. So
yeah, I don't think I've honestly looked at CCL in over a year, so it'd be cool to look at it. I mean, I had back in it was kind of like a what am I trying to say? Kind of like a Hail Mary pass. It wasn't thousands upon thousands of dollars, but it was like, I think I bought like $500 worth of Leaps or something during the pandemic and sold it when it got to like $20. So it wasn't like I made hundreds of thousands of dollars. It was like maybe $1,000, $2,000. It wasn't a lot, but in reality, I was like following it because I wanted to. It was always kind of floating around the $20 range. So I was like, if it dips back down to below 10, and I know it did at one point, I want to get back in, and I never did. But after that, it kind of fizzled out. There was other things that were taking up my time, Palantir, Rklb, things like that I'm really focusing on. So that's a good one. And then, is there any other ones that you want to touch on tomorrow? I'm thinking that's a pretty good slate. Celsius and Carnival.
I'm giving away. I feel bad for my Patreon people because I'm giving away all the.
Don't do it, man.
All the secrets.
You got to keep. And for those of you guys that are curious about Hot Chris's Patreon, man, always check the description. We always got that. And if you're ever curious about becoming a member of the Matt Money Gang, please be sure there's a little $sign if you're on a PC right below the chat box so you can become a member. I think there's 2 tiers. I think I have like a $2.99 and a $5.99. It's just to help, donation for the channel, and all that money goes into Hot Chris's and I's public account, which we also talk about the public account tomorrow because we bought some stuff today. All that stuff we talked about a little bit earlier. Was that yesterday? Today, we did do some of those, and I bought some Rklb as well, but we'll talk about that more tomorrow. Because it didn't drop as much as I wanted, but it also didn't moon. So I was like, okay, good opportunity. Anyway, would you rather move into Rklb or Disney first? How hot are you off the? Are you still sleepy from laying down, or you want me to take over for Rklb?
No. I
or
would
you want
say
to drive Disney.
Rklb honestly does not interest me nearly as much as something like Disney does, only because there's no real way to value Rklb in the future because there aren't any public space companies out there that are generating money. So there's no comparison. You know what I mean?
Yeah.
It's like,
it's very funny. You say that, but like the Q&A was like very much around that. It's like, are you guys going to raise launch prices because Virgin Orbit went broke? Or are you going to have you started, they're coming out with a Neutron, which is their medium launch vehicle. They're like, have you guys started acquiring customers yet? Like all these things where they're trying to gauge future profitability. And Peter Beck, being the guy that he is all about execution and not overselling or overpromising. He's very much like a, what you see, what I say is what you get kind of guy. With the assumptions that are kind of at hand. He doesn't try to fluff or sell anybody anything. And everyone's just sitting there so tell us how, why don't you take on more debt and do this and get as much. And it's it's not how we do things, man. We're bootstrappers. We do things as cheap as possible to figure out ways. And then once it works, we'll expand it over time. We're rather do that in a safe environment, be capital conscious rather than immediately going into let's buy this facility and hope everything works out for the best and we'll be able to do 20 launches in the first year. It's just no, man, sometimes slow is better, especially when Elon didn't start at 100 launches a year, and neither did he have the capacity or facilities to do so. Elon bootstrapped himself and he ended up doing great with SpaceX. So some food for thought there. But we'll kick it off with Disney, so I don't bore you for half an hour, and then if you want to fall asleep and sleep with your eyes open for the last half hour, we can talk about Rklb.
We should also cover Japan, because I think there is a lot of value that not too many people outside of, I guess I don't even know if anyone on the YouTube community is even talking about it, to be honest with you. But
the bonds or just what's
no, there'd be the yen itself, just buying up the yen. I'll like I said, I'll explain towards the end of it, because I think this requires a lot of nuance to understand how currency prices work, especially when you're dealing with like monetary policy. But basically the BOJ right now is close to ending negative rates in January. And so if you think about it, what's going to happen is the yen is going to probably appreciate going forward, and you'll see the dollar depreciate. And there's actually a really good trade to be made right now on that. So normally I'm not a currency guy, but sometimes the opportunities are just kind of vast. So there's a way to play it too via an ETF that maybe we can go over. I was going to keep that as a Patreon exclusive. I should probably keep it as a Patreon exclusive.
Dude, yeah, I mean, I'll tell you what. If we get some time at the end, we'll talk about it maybe, but keep it as a Patreon exclusive, man. People need to. This is the thing, is like, I don't mind going into a little 20-minute, 30 minutes here and there, but like your Patreon, I don't mean this to be like a sales pitch, but like it's a fucking another level. Like, as much as we talk about going into details, Cashflow Chronicles, we're actually diving in through some of the numbers, doing a little bit of DD. Some of this stuff you can't cover in an hour's time, right? And I don't know how you put the time together. It takes a different kind of human being to do what you do on your Patreon. And it's not videos. It's like literally like articles, pictures, graphics. You do a really good job. And we try to do it justice live. But I feel like when you don't have the time, like you're in front of an audience, like you're just trying to have a conversation, you can't get it as succinct and like crispy as you want it to be unless you come prepared, Yeah.
And also a lot of data points are easily shareable via charts and explanations that are easier to just kind of show. Rather than trying to do the opposite, which is trying to just talk about it. So I want, like I said, I never intended the Patreon to be like an exclusive thing. I always figured that that'd be for supporters, but I feel like with all these people kind of giving me some money, it's like, hey man, I want to provide some additional value that I don't necessarily give to the general public and the general market, So
yeah, and then before we hop into Disney, I know you do. Explain a little bit more about the Patreon, because like I know I do it to check in on some of the articles and stuff that you write from time to time. But I'm kind of curious. You're not doing like the one-on-ones anymore. Are you still doing the weekly call or not so much?
No, I am. I've been meaning to do some weekly calls. So I've just been kind of slacking with that, but we're gonna get back on it again. But I'll show you guys like what I do specifically, and I think this ties
Chris, you're giving away the shit for free, guy.
No, it's all right. I'm gonna show you guys what exactly how I run the Patreon that I have and basically how it works. So as an example, this was way before when I was talking about Disney. So I did a multi-part analysis of Disney and why I thought there was value in Disney. So anyone who was in the Patreon kind of already knew about it. So let me just go to it real quick. Same thing with Truist and everything else, but let me just find it. Jeez, man, how much? And I do
like almost saying, guy. That's what I'm saying.
I do a post like every day. So
you do a good job like posting, right? Like you put a lot of effort and time into these things.
Let me just.
I have a question. Why don't you do Seeking Alpha as well?
I thought about it, and like a couple of friends of mine would love me to do that, but I don't know. I'd rather just do this. It makes more sense to me to keep it small. I can address like individuals like on a personal level that
you can get some trolls on Seeking Alpha too.
Not just trolls, but okay. So god damn it, man, I really did do a lot.
I'm saying, guy, like I'm over here trying to pat your back and you're like downplaying it. Like this guy's putting in the real work.
I gotta. All right, let me.
There's a reason why I call him Hot Chris the Daisy God, my guys. Like I'm not just trying to blow him up.
So So let me start off by, okay, so with Disney, I finally found it. Shit, man, I had to go back like almost like 3 months to get back to Disney. Okay, so there we go. So the title and the article that I did was something called Repairing the Brand. All right, so Disney's whole thing is that it's a turnaround play, right? Now, what are some of the things that cause Disney to go down? So I wrote an entire article about, hey, you know, they had some issues with how they handled the Florida governor issue with banning books and banning some of the stuff around, you know, I'm not going to go into it too far, but basically right now Disney is known to be a woke corporation, quote unquote. And the thing is, like, if you go through all the data points that you can see, Disney's actually trying to kind of change that. Fuck it, man. I'm not going to do it right here, but Disney's changing that but it's not going to be something that happens overnight. Not to mention all that content is, you know, from 2 years ago, and then literally all that production ramp and everything else is coming down now. So what it is going forward, the company's got the message. Like, they understand, like, hey, listen, we are in a point where we're in an existential crisis, whether or not we continue to operate how we operate. And so there's a lot of fundamental changes this company is making in order to get to a point where there actually are recovery. There's a lot of financial engineering that they're doing in the background also that not many people really know about. But all in all, you can already see that the benefits are starting to come around. So the key to Disney is not to look at its earnings, because I think if you look at our earnings, it might seem frothy, but instead to look at its cash flow. Because at the end of the day, you have to look at businesses in the metric that most accurately gives you an idea of what their valuation should be. So for Disney, it's all about cash flow. The more cash flow that they have, the more money that they can basically use to invest in future prospects and future projects to generate more money. On the other hand, if you look at it purely just based on a PE, what you're going to miss is you're going to have all this operating income, but then because of the nature of how depreciation works, they take a lot of depreciation up front for their content that they create. And that depreciation is beneficial for them on based on taxes, for tax purposes. So one of the things that people, when they look at Disney and they just look at it purely based on EPS, that's not the metric that I would use. I would use cash flow. And you can see here in FY23, they substantially grew their cash flow. And during the earnings, they actually projected that they're going to do about $8 billion in free cash flow next year. Just think about that. $8 billion. That's almost pre-pandemic level of free cash flow, which is amazing.
And that's free, right? That's after capital expenditures and stuff of the like that
Correct.
They're going to be putting back in. So I think that's able to be used for debt pay down. That's able to be used for dividends. That's able to be used for buybacks. That's able to be used for whatever the hell they want. And when you think about it, it's a $156 billion company, right? $8 billion worth of cash flow. I mean, that's a price to free cash flow and that's free cash flow. That's not just cash flow. That's free cash flow. It's a price to free cash flow of like less than 20, which is absolutely phenomenal. And if you look at the price to cash flow from operations, I'm sure it's going to be on the order of, I don't know, 10. No, not 10, probably closer to 15, 14. I don't know.
I love Garcia. He said Chapek died for Igerson.
Man, I was like, oh, we're good. Back in the day, I was like, oh, we're going from Bob to Bob. They probably vetted this one pretty good. Well, that didn't work out at all. Like, you know, the first quarter, I was like, oh, this guy sounds pretty good. He's not as articulate or like dreamy in terms of what's the word I'm looking for? I guess articulate's probably the best word. Executive or visionary like is what Iger was. But I was like, this isn't bad. And then it just kept getting worse after quarter after quarter after quarter. Anyway, he let the E&I agenda run the company a little bit too much, I think.
You know, did you hear that they might be bringing back Robert Downey Jr. and Scarlett Johansson? There's a rumor.
Don't tell me that guy. Don't tell me that.
No, it's true. That's what I heard, man. It's on Variety, man. I'm telling you, they're trying to bring them back. They know what value looks like. And dude, I would love to see Robert Downey Jr. come back, even if it's not in his role as Iron Man in another thing. Dude, guy's an amazing actor. I'd love
that. There's very few roles. I'll just be blunt, and then I want to get into these numbers a little bit because I feel like we're cheating people, but at the same time, this is cool shit, and I love talking about this. There's very few roles that fit someone's personality so well. It's like there's that role for Robert Downey Jr. as Iron Man, which I think fits absolutely perfectly. Billionaire playboy that has like a fucking engineer mind that absolutely kills everybody. And then I'd say Christian Bale as Batman, I think was one of those. And then crap, what's his name? Jeremy Piven as Ari Gold from Entourage. So there's like very few. That's like, have you read the book, by the way? Just curious if you read, I forget, Ari Go for Gold or something like that. I forget what it's called. Anyway.
No, I haven't read it. No.
The book is written the exact same personality. It's written by Jeremy Piven. It's pretty funny. I'll send it to you. But just some food for thought. Like I like that thought. Scarlett Johansson is actually pretty good as well. Not just because she's good looking, but actually I think she does a really good job fitting that. Heath as well. Heath is the Joker. That's true. Yeah, shit. I didn't even think about that. That was like watching that on screen was just absolutely crazy.
Dude, they're going to have Hugh Jackman in Deadpool as Wolverine. I want to see that. That is going to be my... Like, I'm going to tell the wife, like, block the weekend. We're going to see that. You know? I love Deadpool.
I watch the Deadpool videos. They're pretty funny, man. I didn't realize it. I watched them out of the theaters, but they're pretty funny.
Yep.
All right, so walk us through this. I mean, I saw a little bit. I didn't get too much. I was kind of distracted, so I didn't hear as much about the fiscal year 24 thoughts, but I was looking through the numbers for 23 because this is the close of their fiscal year 23. So I had a lot of kind of full year numbers, which is kind of cool to be able to relate back to what's going on in 2021, 2022, and that rebuild back, because if everybody remembers, the pandemic happened, and then also the push for Disney Plus, which ate up a lot of cash flow from 2019 forward. So that progression back to pre-pandemic levels, specifically on this slide that we're looking at here, is pretty vital, right? And so I'll let you talk a little bit about it.
So the transformation here is that Disney is going from quantity to quality, right? So one of the things that they really did was they spent a lot of money on quantity of content, and they really dropped the quality. The quality of Disney's content has been poor and lackluster, and it shows. You know, like not as many people really like a lot of the shows. They're very, I don't know how to describe it properly, but you rather invest in AAA content that everyone can gravitate towards rather than just doing like all these you know, smaller projects. So as an example, you have all these like side quests. Like that's the best way to describe it. Like with the MCU, where they keep doing these side quests and spending all this money on shit that no one watches, right? Like I think the last one is like Invasion or something like that. Like no one really cared for it that much. Secret Invasion, which was like whatever. They would rather do a few AAA rated movies that really like capture the imagination and bring people into the universe. So this is about universe building. And I think they realize that they need to get back into universe building, right? So that means that, hey, if it costs a lot of money to basically build out a universe, it's worth it to do that rather than just do like this whole bunch of side quests, hoping that it keeps people's attention for a prolonged period of time. So I feel like
the route that they were going, and you know, these numbers are wrong, right? So I don't have any method to my madness here, but like, I feel like they could spend about a third as much money and create maybe half as much money doing a third of the amount of films and get approximately the same amount of revenue just based off of just putting a little bit more quality into it. Because you think about it, it's like all you really need is a good movie per quarter, whether it's a Pixar, whether it's a Star Wars, maybe, whether that's, you know, and if you have these good universes, you could do a year or two in between. And it's like, if you get a good movie per quarter that gets out $1 billion to $2 billion worldwide, I mean, Jesus Christ, like, why are you spending so much time trying to put out like 3 movies a quarter? Like, it doesn't make any sense in a lot of cases. So just some thoughts.
Yeah. So that's why if you look at the headline right there, which is we expect significant year-over-year increase in free cash flow in 24, because they realize that there's a lot of cost cutting that they can do. They're down 8,000 employees from the previous years, primarily from their entertainment division, which there's just a lot of redundancy that they've been able to cut. And on top of it, they've been able to use the Netflix business model to get back into shape. And I think that's going to be the true value of Disney, because remember what happened to Netflix when Netflix started to kind of go under and then they changed up their business model. They said that at one point they would never put ads in their subscriptions, but they did it. Then they raised prices. Then they did password sharing stopping. Disney's following the same script. And with Disney's content, it's going to work out, in my opinion, where you're going to see ARPU jump and you're going to see cost down. So that means that it's going to increase profit. And, you know, we're going to do well.
Would you rather talk about this right now? Seymour Doc, thank you for the $5, man. Much appreciated.
Yep.
That's going to go into the public investment account for you guys to look at over time. Do you want to talk about the quarterly operating losses? Do you want to talk about the ARPU like you were talking about? Where do you want to
let me bring up the slides myself. This way
Drive me, Daddy. Sorry, I won't do that. I won't do that. I'm sorry.
Let's see. Hold on one second. Let me just pull it up real quick because I think
you got to do it at least once a show.
Okay,
keep people on their toes.
Here we go. Share screen. Da-da-da-da-da. I'm kind of excited to see this new movie, Wish. I think it's going to be pretty good. I know a lot of people are like, Wish? It's like a Disney movie. It's featuring. We can watch the trailer in a little bit. Hopefully, they don't.
Yeah, I love this.
You know, but so streaming profit. Like, so these are the key goals. I love when.
Do you want to share it, or do you want to?
Oh, can you see my screen? Oh, I haven't shared it. Sorry.
Yeah, no worries. Got it.
There we go. Here we go. Can you see that?
There it is.
So this is the earnings presentation from today. The first thing is I love seeing businesses when they start to kind of like tell you what they're doing in terms of execution, because I think execution is the key thing that drives business value. And I think Bob Iger is good at executing visions. I do think that there was some tragedies towards the end of his tenure that had to be sort of course corrected. Right. But I'm not sure that it's completely Bob Iger's fault on that. I mean, yeah, he takes the blame because he was at the helm. But essentially, these are the core things that they're going to be doing. So number one is they're going to try to get streaming profitability. They're getting way better with that. And I think they're going to get really close to it in the next couple of quarters. And then they're probably going to be operating income positive with streaming, which will be a phenomenal improvement from where they were less than 2 years ago. So that's number one. Number two is future of ESPN. They, you know, right now, the biggest challenge to ESPN's business model is that you're having guys like Google, Apple, Amazon, and X, Y, and Z compete against them for rights to stream all the NFL, all the leagues. And so one of the things that ESPN has is ESPN has a really strong brand behind it, and they have existing contracts. So one of the things that they're going to do is they want to partner with one of these big tech companies. I think at this point, it's pretty much, you know, like a given that they're going to do it, where they're able to kind of use some of the infrastructure that they have. They have some of their marketing over there and basically create like a synergistic approach to growing. So instead of competing against big tech, they'll be a partner with big tech. And I think what that'll do is help drive more user growth, number one, by bundling with other services. So let's say they partnered with Amazon. They could get, you know, a partnership where Disney Plus would be tied into your Disney Plus, and ESPN would be tied into your Prime subscription. Or let's say they did that with Google, and if you subscribe to YouTube TV, you could get that. Or if you did it with Apple, you would get Apple partnership with Apple TV, and you get like a side thing with ESPN. So everyone does like seeing ESPN, but the key is how are they going to do it? So right now, from what I'm hearing, there's probably going to be a bidding war in the partial ownership of ESPN. They're going to keep it because it does generate a significant amount of income for them, but they are not opposed to partnering with somebody. And basically that is going to help drive growth value and also at the same time generate some cash flow because they're going to be able to sell a portion of it. So, you know, that's,
I will say that that's a really good business model because we've seen how well and the NFL does on Thursdays with Amazon. And I was surprised at that. And I think that YouTube TV is doing well with respect to broadcasting a lot of the games as well. So, and that's a Google product. So I'm very curious if Apple's going to try to enter the game.
Remember, Apple has MLS, right? So even Apple has aspirations and dreams of getting into the sports world. So, you know, you want to partner with someone who's got that instant brand recognition from decades upon decades.
I've heard F1 is doing the same too, right? Because like I do an F1 subscription. That's like $70 a year or something like that. But I'm sure if you were able to collaborate with some of these studios or even some of these tech folks, they might be able to contribute a little bit more capital to actually like build the F1 brand. Because like they have Drive to Survive on Netflix, but like other than that, you know, they really show is, you know, the background. They have the Instagram page, they have all that sort of stuff. But there's nothing like that goes into a little bit more, you know, details about specific drivers, or only thing they really have is Drive to Survive, which they highlight 1 or 2 drivers per episode. So anyway, I like that sort of thought. And now that you mention it, I can kind of see that a lot of people are going down that path. So I'm really curious how, and ESPN's a great brand. I've been, you know, when I was in high school, before school started, that's all I would do is I would just look at it, look at the top 10. So I could literally just like talk about it with people throughout the day, and then at lunchtime it was always on. So anyway,
and then like I mentioned before, studio creativity, where they're committed to doing more storytelling, you know, instead of just pumping out a bunch of shit content just to have something. And I think this is important. And I think this is the one that Bob Iger is going to take a personal kind of like hands-on approach to kind of fixing this part of the business, where it's going to try to be a lot more mass market, mass appeal, rather than kind of pandering a little bit, as Garcia is saying in the chat. So that's another thing. And remember, at the end of the day, businesses are going to do what's good for the business. So they understand that, hey, going woke equals going broke. So they're going to do what they can to change that, you know, or at least change the perception of it, where they have more inclusive characters, but at the same time, not alienate everyone by kind of doing some of the things that they've been doing recently. You know, like, did they have to race swap the Little Mermaid? No, they could have created an original character specifically that, you know, people could fall behind, that actually
like Moana did phenomenal and Kanta did really good. Like why do they have to? Doesn't make sense.
Yeah, so that's the thing. So a lot of people were very like, and they voiced their opinions very strongly that, you know, you're trying to change original content to fit a certain narrative. So like there was so much backlash. I don't know if you saw with Sleeping Beauty and like the Seven Dwarfs. Instead, it was going to be like some magical creatures nonsense. And so everyone was like, what the hell? Yeah. Like, you know, so these are the kinds of things that like Disney really flubbed up on. And I don't know who the creative genius was that thought, hey, let's alienate a whole bunch of people by forcing ideas on top of people. But it didn't work out well. And I don't think going forward, it's going to be a thing. I think there's been a lot of evidence that people are waking up from the DEI initiatives, waking up a little bit from the more radical parts of the ESG agenda and saying, you know what, we need to get back to some neutrality. And hopefully that trend continues, because even I don't like seeing everything kind of get like I don't want to call it whitewash because it's probably the wrong word, but pretty much get woke washed.
Yeah, woke washed. I like that term. I mean, I agree with you. It's like, I agree. Everyone should have the same opportunities if they're competent enough. And, you know, I see that a lot at work where, you know, that you don't want to discriminate or not give somebody an opportunity to do some things, but you want to make sure at the same time that those people are able to pull off, you know, what they're up against, right? You don't want to, I guess, out promote and
There's also another key thing, and I'm glad George with a J brought it up. The thing would like really piss me off when I saw She-Hulk twerking. You know, Disney is known to be, and it's supposed to be, entertainment where families can get together and watch it together, right? And the last thing you want to do is have explicitly sexual, you know, content out there that basically makes everyone kind of squirm a little bit. You know, not to say that, hey, twerking is a bad thing, bro. As an adult, go ahead, twerk all you like. I'm not a prude by any means, but dude, if my 5-year-old is like learns how to twerk, I'll be like, hey, what the fuck? You know, like, who taught you that?
Yeah.
It's like, oh,
conversations years ahead of when you really need to have them. You know what I mean?
Yeah, interesting. Exactly. So it's one of those things. It's like, oh, okay. And last but not least, their parks and experiences. They're going to build out more stuff around their parks, you know, improve what they have in the parks expanded out so that you don't have this bottleneck of people coming in and having a terrible experience. Like one of the worst experiences that you can have at these theme parks is you go and you have to wait an hour and a half, 2 hours per ride. And the entire time you're just baking under the sun. Like, no, you have a clear, like Disney has a lot of property in Disneyland and Disney World. They need to spend the capex on building more rides. Get it so that there's more capacity, because right now you're hitting capacity limits. So what are the things that they're doing is just increasing prices. But at some point, the price increases are going to like be a very like, you know, it's going to turn people off. So focus on expanding out that availability of park space, right? So they have the real estate, they have the IP, they have the content. So now it's time to kind of build it out. And they've committed to spending about $60 billion over the next 10 years, expanding this part of this part of their offering. And this generates them so much money. It's totally worth it on an ROI basis. So I'm not even concerned. So I think Disney is making the right moves, making sure that they keep investing in their parks and experiences.
I did want to you mentioning the entertainment piece and the sales and the parks and recreation part of it. The Disney Cruise Line, I'm just looking at a couple slides ahead of this. Disney Cruise Line started sailing in Australia and New Zealand starting in October 25th. I know we were talking about potentially doing a cruise for JunkieCon 2.0. So I'm curious, would you do a Carnival cruise or would you do a Disney cruise if you had to do Finance Junkies Con 2? Curious.
Well, you know, as an adult, because I don't have kids and I don't like, if we do a Junkies Con, it'd probably be like maybe the adults plus some kids. Probably end up doing, probably do just Carnival. You know, maybe in the future when everyone's got kids and stuff and they want to actually do this, maybe a Disney cruise. Disney cruises, by the way, notoriously expensive. Like there's so much demand. They are expensive. Yeah.
Oh, yeah. Well, I didn't know that. Okay.
Yeah. Carnival is like the budget friendly cruise line. You will see you'll see your more. I would say Carnival is like the Spirit Airlines of the cruise industry, right? Royal Caribbean's like the Delta, Norwegian's like the Southwest, and then you've got Carnival, which is like the Spirit Airlines or the Frontier Airlines of the cruise world, right?
I'll take that.
So just letting you know. Then you have the cost savings. I think this is important too. So initially they had targeted for about 5.5 billion in cost savings. 3 billion was going to come from content spend, which is they're going to limit the amount of money that they spent on additional content. And another 2.5 was going to come from, you know, sales, general expenses and amortization. So this is another, but they're upping that significantly. So they're actually cutting back a lot on content because they realize that, hey, it's better to spend less money on limited content, but make that content as widely appealing as possible rather than just doing small hodgepodges of small content just to have content, you know. So that savings is going to be huge for them. So about 7.5 billion in cost savings by the end of 2024.
I just want to jump in here. Somebody said Junkie Juniors, and I like that for the kids. That's
fun. And so you can see here that they're not cutting back on spending like capital expenses for like the parks and recreations and stuff like that, but they are kind of cutting back on produced content and licensed content. That's the key that I like to see, because if the content does not provide true value, why are you paying for it? You know, like why would you license a movie or a book that does not translate into additional profits that help you grow your business? You know, so be methodical with your content spending. And that's what they're doing right now. They're being very careful with putting content. And I think this is the key. This is one of the key things that I like about Disney right now, is that they understand that they overspent on content, and now they're going to normalize that. And hopefully they get back to the 2019 levels, you know, because if you think about FY 2019 and 2019 and 2020, these were the highlights of Disney when they were coming up with Marvel's Endgame. Think about it. Yep. Versus today, they're spending 27.2 billion. And it's like, what the hell? We spent 27, we'll get worse results than when in 2019, when we had blockbuster hit after blockbuster hit. And yet now we're spending more, yet you are doing worse at the box office. Just think about that for 2 seconds. It's crazy. So they have to be a lot more careful with their content spending and their capital expenses on that, and they're doing that. So I think this is a good growth trajectory for Disney on where they're going with their
I mean, that's part of the business model for Disney that always worked, right? It's like concentrate on quality of assets, the IP, rather than like the quantity. And the IP, the reason why it's important is because that's what fuels the parks. That's what fuels the plush toys. That's what fuels the trademarking and licensing deals down the road. And so instead of just trying to like outflow all this stuff, it's just like, I don't know, like you want something like a Frozen. You want something that is going to stick in kids' minds that they're going to want to see. Like if you had a Frozen theme park at Disney, kids would go to that. The Hulk, like people would go to the Hulk. Well, I guess there's IP issues associated with the Hulk, but Spider-Man, there's IP issues with that too. But what I'm getting after, right? Like you have these things that have been historical, that have either been acquired over time, that they're not like one-offs, right? They're like significant, the storyline continues sort of stuff. And like, if you just do these small little one-off movies, you can't build the IP. Like that's what's made Disney so successful going on 100 years.
Yeah. So FY19 and FY 2020, one of the reasons why you see this depressing number, of course, 2020, you had COVID, but 2019 is when they did that giant Fox acquisition. So they spent a buttload of money on the Fox acquisition. Rupert Murdoch made out like a bandit when he got that done. So it's just one of those things that really cost them a lot of money. But that's why FY19, otherwise FY19 would have been much better up here too. So just letting you all know that this is a business in transformation, but if they can get back to this right here and this right here, which looks like they're going to be able to in 24, you're looking at a substantial increase in share price, especially
not
if they
only
use
that
free cash flow. Yeah.
Not only that, like I'm just looking at slide 11, which I know I'm skipping ahead, and I apologize for that. We could skip back once I'm done making this point. But like if you look at the light green on slide 11, which I think is one above this one.
11. Okay. Yeah.
Yeah. If you look at the light green, which is specifically the direct to consumer, it's like Disney Plus, the Hulu, all that. It went from $4.5 billion a year ago in terms of revenue to $5 billion. So an increase of 10%. But the operating income, or in this case, a loss for DTC, increased by $1 billion. So you only increased the revenue by $500 million, but the loss decreased by over $1 billion. So it's like, if they continue, especially what we're going to show on slide, or maybe it's the next slide, or I forget, but the price increases, we actually might be lower down in the pack, but like it's gonna get pretty good. This thing's gonna actually start contributing a lot of money after being a loss maker for, let's just say, the past 4 or 5 years. So
yeah. So you can see here, they've been pretty much topped pretty much out at where their domestic subscribers are for Disney Plus and the ARPU that they generate. So now it's kind of more about like international, growing their international subscribers, which is going to be, something to see. But overall, you can see in their sports division, this is their moneymaker. Look at ESPN domestic. They made $3.4 billion in revenue. They almost generated $1 billion last year, and this year they generated $1 billion. That's amazing. You gotta love sports, man. Sports is so monetizable. It's amazing. And then so if you do all the combined calculations, you can see here in Q4 of 2022 they were losing about 1.5 billion per quarter, and they've narrowed that down to only about 0.4 billion. And so if we look at this, if they're able to do the same exact trajectory into 2024, you're going to see about, this is a $1.1 billion improvement. If they're able to do a $1.1 billion improvement this way, that ends up being almost 600 million in additional operating income by Q4 of 2023. I mean, I'm sure that it's not per quarter. Yeah, I'm sure that it's not going to be that high, but you never know. So I'd say maybe 300 to 400 million in operating income can probably come from their DTC business by 2024 quarter 4. which once again just adds right back to the bottom line. So instead of a loss leader, you have you have an income generator. And so this will
take that thought process too, right, Chris? I mean, we're seeing it with the price increases on slide 17, but even talking about this started in 2019, and there's 100 million subscribers with the domestic as well as international. If you think about it, they were pricing this to get as much people through the door into it as possible. They knew they were going to lose money. Now they're getting to the place where it's like, we got 100 million people in the door. Who cares if you raise the price 20-something% and you lose 5% of the people? You're still walking away 15% up positive for the year. And those people are probably going to come back anyway because of the IP. So I think part of it might be, a piece of the slowdown might be because of everything with the go woke, go broke sort of shit. Or it could have been the fact that there hasn't been some good movies in a while. They're going after quantity rather than quality. If you bring some back of, what drove me to want to get Disney Plus, all the Marvel movies, all the Marvel movies, all the Star Wars movies, all that sort of stuff. Like that's what's going to keep people in the door, especially if you do it classily with a lot of class. So anyway, back to you.
Yeah. The other thing is they're going to be doing a lot of bundling, which is also good, because what happens is, why pay for one service and another one when you could just bundle it together and basically capture an entire, pretty much a family, where ESPN, the dad has everything, Hulu covered for mom and the girls, and Disney Plus covered for everyone in the family, So I think the value proposition of mixing these bundles together is going to be very interesting, and it's going to be interesting to see. And we'll see how Disney does. But I think DTC is going to be good for them, and we'll see what happens.
Yeah. Did they give? I'm sure they mentioned it in the Q&A. Did they give any color about Hulu and what's kind of going on with respect to the buyout? Did they give any timing associated with that?
Yeah, so they are going to pay the minimum price that Hulu gets to cable to Comcast right away, and then whatever the difference is in the price afterward, like once the deal is done completely, they'll pay them whatever that figure is, but because they're still trying to determine what the exact value of Hulu's stake is, but they wanted to get the deal done, so they pretty much said, here's the base price, take the cash, let's start integrating all the Hulu stuff right now. So Hulu right now, they're already starting next month. They're going to be beta testing. So basically you're going to have a single app experience. So basically Hulu and Disney Plus are just going to become one thing. And I think eventually it'll probably do ESPN too. So you just log into one app and you've got everything, So the value proposition is probably going to grow with that as well. So we'll see what happens with that, Yeah,
because if you think about it, it's like, I'm sure they'll find out a price model that works sufficiently where it's just like, I doubt people will subscribe to all three, but they might do all three combined if it's only $1 or $2 more, and they'll probably figure out a way to say, okay, well, we could charge, let's just say $10.99 per month for ESPN, but we'll get 3 times as many subscribers if we only charge an extra $5 per month if we bundle it with ESPN Plus or not ESPN, Disney Plus. So I'm curious. Do you think they're just going to call it Disney Plus? You think they're going to call it Hulu?
I don't know. I don't know what they're going to call it.
I guess we'll find out.
Yeah, but here's the other thing. So they are, like I said, investing in capital improvements in their parks and recreations division. So right here, you can see in Disneyland Resort, they're spending all this money here. They've got a World of Frozen, which looks phenomenal in Disney Hong Kong. Then you have all here is what I'm kind of excited about. Disney Treasure Adventure and a third class of cruise ship. So they're growing their cruise lines business as well. And that's actually been an operating income generator for them in the past that kicks off dividends because it's run like a separate company where they do all their operating metrics and everything else. And then they just throw Disney, which is the parent company, a giant dividend at the end of the year or every quarter or something like that. But essentially it's one of those ATMs for Disney that they can reach into. So yeah, that'll be interesting to see. And all of that stuff is going to come out in 24 and 25. So
silly question, because I know last quarter, people were jumping at the fact that like, oh, they said that they might install a dividend again. And I know there's still some people butthurt from 2018, 2019 days when they cut the dividend, you know, to be able to help pay for the DTC and the direct to consumer piece of the business, because they were running at a loss, and they're like, we'd rather save the $2 billion a year, put it to DTC, get that profitable, and then come back to the dividend later. Did they give any color to that in the earnings call?
Yeah, they're going to do a limited dividend, I think, in Q4. And going forward, they're going to try to get back into like dividend mode. But one of the curious things that they also mentioned was the possibility of doing share buybacks, because at these depressed prices, it actually makes more sense, instead of doing dividends, to actually just do share buybacks. You know, dividends are great, you know, for the income driven consumer. But if your value of your stock is underappreciated, bro, you want them to buy back as many shares as possible while it's on the cheap, you know. And I'm glad Seymour brought it up. The price increases, I think that's worth examining just a little bit. If you look at the price increases, they only happened in the premium, the non ads one, because they can monetize these ads so much through targeted advertising. So one of the things that you're definitely going to see is a vast improvement in targeted advertising on Disney Plus, in which Disney Plus, Hulu, and of course ESPN Plus. And what that'll do is increase ARPU for the end for the company itself. So, you know, that'll be a curious new addition in terms of income for these guys, you know.
Interesting.
Yeah.
Do we buy a share of Disney for the public account or no?
I think we should. I think we should, as a tracking mechanism.
I think we got a couple. I don't know if we have $150 or $180 left. So it could be an opportunity. I might maybe throw it in there for tomorrow.
Yeah. Yeah. Just throw one share at it and see where it goes. Yeah. You know?
I have 50 something shares. It's not a big position, but enough to make you want to stay and look at it and hope that it. At one point, it was a lot bigger, right? When it went up to $190, and I was like, should I sell? I was like, no, it's going to go to the moon. It's going to go to $300 like Netflix. But I was an idiot. I should have read the writing on the wall and did a little bit more due diligence. And I think I was too invested in the flashiness of everything else that was going on, and writing options and selling options and making money that way, that I was like not even concerned about my, you know, I think it ended up being about $9,000 or $10,000 position in Disney, because I had 50 shares and it's $190 or whatever. So it just didn't make any sense. Okay, cool. Well, cool to that. We'll be sure to add a share into the account. Let me kick us over to Rklb. So the thing that I liked most about Rklb, and I started with this, but now that we got a few more people kind of in the screens these days, chiming in a little bit later, the thing that I liked most about this was they gave a lot of color around the actual anomaly that happened at the end of Q3. And so for those of you guys that don't necessarily know what happened, sorry, there's just like a little pop-up on my screen. There we go. Let's fix that. The launch went okay for their 41st small launch. So people that are unfamiliar with the company, they've been launching rockets since late 2017, early 2018. The Electron rocket is small launch, so it doesn't necessarily compete like for SpaceX's Falcon 9 or the Starship Heavy or anything like that, Falcon Heavy. But it does provide space systems as well and what have you. We could go into a lot more color and detail about this, but I'll speak pretty general about a lot of different topics. Because there was a lot of good coverage in the Q&A section that I think was really important to kind of go over. But just to give people some color around what happened, so they had a second stage failure. So basically, once you get to a certain height, you launch a second stage to be able to shed off some of the dead weight as you kind of propel yourself up to higher in the atmosphere. Second stage kicks off, and then you go into orbit, right? The second stage kind of shorted out like a minute, or not a minute, like a second or two right after ignition. And so therefore it killed the power for the basically second stage, and it went back to Earth, right? So failed in that respect. So everyone's kind of like, well, that's not good, right? So let's just check and see what happened with that. They released an entire investigation, and they did like literally like a 2 to 3 minute kind of conversation walking through step by step. It was like very transparent about like what exactly happened, how they're mitigating it, like very succinct and scientific, and they've also released some more details and color on this in online as well. So if you go to their X page, they actually released a link to people that are potentially interested. But like they literally were just doing all this analysis about 1.6 seconds of data after the second stage kind of kicked off. So it was really cool. And if you want to see when it happened, just go to the launch that they have on their website, and it's 151 seconds after launch. You can kind of see the failure associated with it. If anybody's really interested, I know I get kind of nerdy about this stuff, but the thing that made me most excited was seeing this. So unfortunately, with what was kind of going on in that after that failure or anomaly at the end of 3Q, it pushed back some of these launches into 2024. So instead of getting 15 launches in 2023 like they wanted, I think they might get 11 or 12. So unfortunately, the launch cadence is going to impact the Q3 and Q4 earnings, which we'll get to in just a second. But the thing that makes me most excited is, and they gave a lot of color on this as well, which I want to talk about, is they have 22 missions booked for 2024. Now, this is their capacity. So they're currently at like 22 missions is where they're at. And they asked, they were like, well, do you feel like you can't take on more clients? And so they're like, we don't ever turn down clients, right? We always make sure that we have space. And a lot of times people might not be ready, right? So this is when you launch a vehicle, they have the launch vehicle ready, but they might not necessarily supply the satellite. They might not necessarily supply the spacecraft that's going into these rockets. So people might kick it down a quarter, or they might kick it 2 quarters. And so they might have a spot opening up. So doesn't mean that they're getting rid of things, but I anticipate they're going to have 20 to 22 launches next year. Some of these are HASTE, so low Earth orbit, or kind of suborbit rockets that they're testing for defense purposes. And a lot of these are confidential sort of clients. You can see there's like 6 or 7 of these in there. And then the normal black electrons are just normal launches. Then you have the reds scattered throughout the HASTE as well as electron launches. Those are when they're going to try to use reusability, or I don't know if it's them going after reusability after this rocket has been launched, or reusing some of the previous hulls and previous engines that have been recovered, because they are trying to get that in there as well. This is a point where I just want to take a quick pause, because they gave some color. Adam Spice gave some color about what the gross margin would be for these launches. And we've continued to see gross margin grow from the high teens to the low 20s to now high 20s on a non-GAAP basis, to the point where now they're starting to forecast in the low 30s. And you're sitting there saying, like, dude, we're putting rockets into space. Like, low 30s for a gross margin is pretty damn good. So like what's going on? And so he gave some color, and I'll talk about Electron right now, but Solero he gave some color to as well. And the thought that he kind of put out there was like, we're going to get close to a 50% gross margin at a 24 mission per annum cadence. So as you approach that 24 missions per annum, or 6 launches per quarter, you're going to get very close to that 50% gross margin, which is going to be huge for the bottom line eventually, right? Because the more and more launches you get to, let's just say they go to 30 launches or 35 launches in 2025 because their capacity increases, that's just going to basically offset a lot of that OPEX that's associated with just running the business, the SG&A piece, right? So just wanted to kind of talk about that, and they kind of gave that color associated with it, because specifically in Q3, which was 2 launches, they were at 27% GAAP, right? So that's not non-GAAP, that's GAAP. So that's pretty good, right? Just with 2 launches, and they're gonna, if they get 6 launches in a quarter, they're probably getting closer to the low 40s on a GAAP basis. Non-GAAP, they're aiming for 50% long term. They talked about a bunch of different things. The Neutron rocket for them is their medium-sized launch vehicle. So instead of doing 700 and some kilograms to low Earth orbit, it's going to be something like 15,000. So much more in competition with, say, a Falcon 9-esque sort of rocket. This will be a reusable rocket. And so they're just kind of going through the stages of delivering some of these milestones. So this is talking about how they blew up some of the tanks, which they gave some color to that. It's like not just blowing up the tank, but if you think about it, this is a lot of the material that they're using throughout the rocket. So you're actually getting stress material, information that can be used as well. So that's pretty cool to be able to see. here's some of the other tanks that they're building, the Archimedes engine kind of model that you have here, and then Launch Complex 3 kind of starting to be built, which is where they're going to be launching the Neutron rocket in Virginia, Wallops, Virginia. So that'd be cool to see. And then here's all the developments that they kind of achieved in Q3 alone, and a few other things that are kind of imminent, kind of coming through that I expect to kind of see going forward. They talked a little bit about HASTE, which is their suborbital sort of launch rocket there, which is going to be huge for defense, and that's going to be, you know, really good for increasing cadence throughout. The cool thing is that Rklb is like, it obviously started as a launch company, and now they've transitioned to an end-to-end satellite. So they're actually developing with Varda and a few other companies like these 0G sort of satellites where they're like being able to, 0G environments through some of the basically crafts that they're building, the spacecrafts that they're building, so they can create environments where you can do chip testing, like semiconductor chip testing or pharmaceutical testing or anything like that. Specifically for Varda, this most recent one that they did in Q3 was testing for an HIV drug, to which it was successful. And that's pretty cool, because if you're able to demonstrate that and get that up and running, it could be a whole nother revenue stream for them for the long term, where every single quarter or however many you need per quarter, you're doing these 0G environment sort of analyses and bringing those back to Earth safely to be able to help develop, you know, the future of whether that's semiconductors or whether that's the pharmaceutical industry. So that's kind of cool to be able to see. But they also provide solar panels as well. This is a good opportunity maybe to take a quick stop on the solar panel piece. Let me pull up some notes that I took with respect to this. And so in the Q&A section, they're talking about 30% non-GAAP gross margin for the solar panel piece, which is pretty good. Not efficiency, right? Because we know that these things are very efficient. They're in the 30% efficiency range as well, which is better than most, you know, terrain solar panels that we talk about, which are in the 15 to 20% range. The efficiency of these are like 33%, which is really good. But we're talking about gross margin, which is basically just like the cost to be able to build and what the cost of goods sold basically is when you get these things out the door. So the current backlog is currently at about 30%. And the ones that they're approving now to the backlog, Adam Spice basically said he hasn't really seen any much below 30% for quite some time. And he thinks that as we continue to get more and more contracts, as the backlog kind of runs through, those contracts are going to be running north of 30% gross margin. So that's pretty cool to be able to talk about, knowing that that's a good piece of revenue from the space systems piece, specifically the Psyche mission that just went to an asteroid near Jupiter that was actually launched by SpaceX, is being powered by Solero solar panels, which is kind of cool, right? You're collaborating with NASA, you're collaborating with SpaceX. It's not just a launch company at this point. It's literally like, what do you need? And Rklb will help get you there. So they talked a little bit about the Global Star production systems, which we'll talk about in just a minute when we get to Q1 revenues. Yeah, this is the Psyche mission I was just talking about with the solar panels. These things are like hair thin, which is pretty cool, because you have to think all the specific weight that you add, you know, is less payload that you can take, or less information you can get from capsules, whether it's gas or rocks or whatever that you're looking for to be able to capture and bring back home. So going into financials, I think everyone knew that these were going to be subdued. 68 million is where they ended up. I think before they had an additional launch expected in Q3 before that anomaly happened. Now they're able to kind of go back, and they have a launch kind of planned for the end of November. So that's going to be kind of cool to see that get kicked back off again. And hopefully they'll have 2 or 3 launches in the fourth quarter, which we'll talk about, you know, kind of a preview look of fourth quarter and the first quarter here in just a second. So this ended up about 9% quarter over quarter. And so this was my kind of concern, scratching my head. I'm like, are we really flattening out this quickly for revenue? And so it's kind of giving me like a little bit of a head scratch going into earnings. And that was my hope, is that I would address it. And they did address it very well, which we'll get to in just a second. Because the thing that was kind of concerning me was just like, we started the year in the $50 million revenue mark and we're only at 68. You're really slowing down comparatively to where we were going from 2021 to 2022 revenue growth. But you can see the gross margin from a non-GAAP perspective is growing to just below 29.5%, and in a GAAP perspective, 22%, which for a launch company is pretty good. And it's only looking like it's going to increase from there as you continue to get more and more cadence going up. Backlog, so it's pretty healthy. They talked about 57% of this 582 being kind of realized in the next 12 months or so. So that kind of gets you around the 250 to 300 million-ish range, if you want to kind of use that as a key to kind of understand where they'll land for revenue for the full year 2024. So they increased that 9% from last quarter. They spent, I would say, a little bit more in terms of operating expenditures and CapEx than I wanted. I was expecting cash to kind of stay at $400 million. And to add some color to this, there's a $100 million debt note that came current as of this quarter, which I think is a July 1st payment or something like that. That's $100 million. They asked specifically about that, and they said that they are in deep conversations with several people about who will refinance that debt. So they're not just going to pay it out of this $374 million in cash. And so that's a good piece to kind of talk about, that they're in good conversations with people that looks like they would refinance it at favorable rates. And then second, they said it would hopefully close by the end of this year. So hopefully by January, February timeframe when we're reporting, again, we'll see some news associated with that. And I'm sure it's big enough where they'd announce it in a separate release as well. But the one thing that they did talk about was, I was kind of surprised at how little OpEx and cash flow deficit they had last quarter in Q2. And they talked a little bit about that. They gave some color around the fact that this is just how some of the payment structures work. They've received a lot of milestone payments for Neutron and several other things that happened in Q2. And then Q3 specifically, they're not getting those milestone payments, and they're looking to kind of be more expensive in Q3 and Q4, and then kind of swing back to getting some more milestone payments for more specifically the Globalstar satellite service businesses in the 1Q timeframe. And we'll talk about that more in just a second as well. And if people just listening, they fall asleep because I don't see many comments going on, and I'm just like talking to myself.
No, I don't think. I think people are just really attuned and paying attention.
Yeah, you're being too kind, Chris, as always. But the thing that they also wanted to talk about was the Virgin Orbit conversation as well, which they said that they got around $100 million worth of facilities as well as efficiencies that they're probably going to realize with that for just the price of 16 million. And so that was kind of cool to hear that, you have an opportunity to buy something in their backyard in Long Beach, and that's going to add directly to the bottom line. So very encouraging stuff, right? So like from a revenue perspective, you're like kind of like, but they're still getting there. And then you get to this profitability trends piece. And then we get to, I think, the next slide, and it starts to get kind of exciting again. Because you're like, okay, they're delivering. They're still in this like chug along. But the whole conversation throughout the entirety of the talk until we got to this point was like, we can see the light at the end of the tunnel to get a launchable Neutron vessel on the pad in 2024, which is always kind of like, when you hear that and you're almost 12 months away from the end of 2024, you're like, damn, like, is this really going to happen? And so after this final 2 slides or so, I'll take a pause and hear if anybody wants to talk about any sort of specifics. But this is talking specifically about how they're growing EBITDA, adjusted EBITDA, to get closer and closer to cash flow break even. And once you kind of pull this in, it's like you're hitting a lot of dependent factors with Neutron and stuff of the like, which, if you think about it, you have a successful small launch vehicle that will launch 22 times, up to 22 times next year, a successful space systems business where the gross margins increasing closer to 30% on specifically solar, but there's other components. I didn't go into too much color about the gross margins associated with that. But that's technically subsidizing an entire development of a new rocket that will be able to, not in 2024, doesn't seem like too much in 2025, but starting in 2026, start to truly add to the bottom line in terms of getting new customers and being able to market for larger opportunities. What those opportunities are, I think, is kind of left to interpretation. But that's when you're starting to truly compete with like the SpaceXs of the world, of like Falcon 9 and stuff of the like. And the thing that's beautiful about that is there's talk of some of the Falcon 9 components, or just the Falcon 9 program as a whole, just being completely dismantled and only focusing on Falcon Heavy and Starship. And so if that's the case, then this will allow them to open up into the medium launch rocket market and only have competition with ULA, which is a collaboration between Boeing and Lockheed Martin. And so that's all speculative at the moment. We can talk about that at a later date as that kind of develops. But the hope is that they're coming into a market that SpaceX is actually technically leaving. So because they're going to be focusing on more like interplanetary and large vehicle launches rather than these small vehicle launches. So this drives me to, what does Q4 look like, right? Because we're getting closer and closer to this cash flow break even. The revenues are increasing for the last 4 quarters. Like what's going on? So look on the very far left. This is Q4 revenue outlook. I was actually surprised that they were forecasting 65 to 69 million in terms of revenue. They are planning on having 2 launches, which is going to generate about $16 or so million. And then they have the space systems revenue kind of coming in at 48 to 53 million. So I was very surprised to see a quarter. I was forecasting they were going to be predicting about 60 million. So the fact that they're starting to get some more and more revenue coming through the door for space systems, then getting 2 launches, is good to see. They continue to increase to these non-GAAP gross margins going into the low 30s, which is something that I want to see. And even on the GAAP gross margin kind of being in the mid 20s is something I like to see. There will still be some pretty big OpEx associated with getting some milestones done. But the EBITDA loss is only going to be 23 to 27 million comparatively to where we were for this quarter. And then 1Q is when things start to get pretty fucking crazy. They're planning on having 4 to 5 launches. So those 4 to 5 launches is going to be $30 to $37 million. So keep in mind, if they get 4 to 5 launches, they only launched 11 in the totality of fiscal year, or will be launching 11 in the totality of fiscal year 23. That they are actually able to meet the 22 launches for 2024, or even if they get 20 launches. Keep in mind, this company since 2017, 2018 timeframe has only launched 41 vehicles. So if they're able to do that, they've literally met or increased the amount of launches that they've had 50% in a single year. So it could be getting to the point where they're getting to a place where profitability is so good, they can start to focus on ramping up and getting to a place where they can get to maybe 30 launches, 40 launches over the next coming years. You can see what that's going to do to launch revenue kind of going forward. You're looking at 150 or so $1 million worth of potential launches next year, as you have 22 launches in total. This is only 4 or 5. You're getting close to $150 million in revenue just from that alone. Space systems revenue is actually expanding close to 30-40% as well, going to $65 million. So overall, looking at just about $100 million in terms of revenue, which is a pretty expansive increase sequentially. And then year over year is probably going to be close to a 80 to 90% increase, because I think Q1 of 24, if I remember correctly, let me go to the previous slide, was 55 million. So it's going to be like an 80 to 90% year over year increase in terms of revenue. So overall, things are kind of looking up with respect to what's going on at Rklb. So my hope is that this doesn't fall apart, and the 22 launches that are kind of in schedule go forward, because nothing would make it more attractive than starting to see the launch cadence really start to open up to the point where this thing becomes kind of cash flow break even. So you think like that's where it starts to truly be beautiful and sexy, because you have cash flow break even and you're subsidizing a new rocket launch, right? That's not necessarily having to take subsidies from NASA or anything like that. It's a true launch business that is successful. And Chris, after that conversation, I want to kind of turn it back to you, because you talked a little bit about at the beginning of the show how you're kind of like, well, I'm not really too prepared or really liking this company because there's not really many other competitors to compare it to on a public basis. And I guess my question is like, I recognize it's about, let me just double check the market cap. It's pretty low right now, but I think it's like 2.5 billion. Let me just double check and then we can get into it. 2.1 billion. So being a $2.1 billion company, having the potential to launch 22 rockets next year, and continue to do well, while others in the space, Virgin Orbit being one, Astra still struggling to make their debt payments, but they did get some short-term wiggle room for the next couple weeks associated with that. And then other companies which have yet to launch a vehicle in 2023. Like, what are your thoughts? I mean, is this something where you're like, it might be something getting closer and closer to that? If somebody wants to take a gamble on something like this, it could be an opportunity. I don't want to put words in your mouth, but I'm curious what your thoughts are.
I mean, long term, they seem to be executing in the right direction. Long term, if they're able to do everything that they're promising and they have enough of a runway, which clearly I think they do, they could be a contender as a competitor to SpaceX. And last time I think the valuation of SpaceX was about 100 billion. So, it's one of those things that's still left to be seen. I think that SpaceX is still way, 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 way ahead of these guys.
For sure.
But they're getting there, And so if SpaceX is the number one, then these guys seem like they could be a promising number two, because there's always number ones and number twos and number three winners. Usually the lion's share of profits tend to go with number one, but that doesn't mean number twos and threes don't make money. So yeah, it'll be interesting to see where these guys end up in the future, because it seems like that heavy investment in technology is going to pay off, but it's going to be a while before it happens. It's not something that's going to happen overnight. So I'd be curious to see what kind of results they have next year and how much they can actually meet a lot of their expectations.
Yeah, I'd say the thing doesn't really change. I think this is one of those things where it's like continuing to meet those opportunities to get further catalysts in the future. So like Neutron is still the biggest catalyst that they have, right? Once that's kind of done and dusted, a lot of their operating expenditures magically disappears, because obviously they're not subsidizing all these launch and testing and all that R&D associated with that. The other piece of it, though, is like how many launches are they going to have to do to get successful with Neutron, right? So the first part is getting it off the pad. If you do that, that's a success, right, in its own. But the fact is they want to have Neutron be reusable, like a Falcon 9 rocket. So how many launches is that going to take? Think about how many times the Falcon 9 had to launch and crash and burn on a pad before it truly was able to be reusable in the long term. So, they did give a little bit of color. So it was like, okay, once we're up and running, like maybe in 2025, we'll start getting some contracts. And that's not off the table, at least what Peter Beck said. He was like, they're going to be more bootstrappy about it. They're going to just try to get to certain milestones, and they're getting closer and closer to those milestones before they're like, okay, we have a tangible vehicle. So the last thing you want to do is be like, get to the middle of 2024 and hit some roadblock and you're like, it's actually going to be mid 2025. And then you hit another roadblock in early 2025. You're like, it's actually going to be end of year 2025. So they're like kind of being cautious and superstitious, being like, let's just get to these certain milestones first, and then we'll start negotiating some contracts, right? And I think that that's going to be a pretty cool piece of where they actually start to hit some sort of pivot points. And then I think the fact that they're going to start getting to a much larger just overall revenue, increasing close to 100% year over year. I think that that's going to be a point where sometime in 2024, you should expect a place where EBITDA break even kind of occurs. Now, it's hard to kind of say because they don't really give a schedule as to how much OPEX is going to be associated with Neutron throughout the rest of 2024. And that's a big chunk of change. And they didn't really give color on this quarter about how much is kind of remaining. but I know probably a couple quarters ago, maybe a year ago, they said there was about $200 to $250 million remaining in CapEx or operating expenditures associated with it. So, now we're kind of a year down the road from that. Is that still 100 million? Is it 150? You don't really know. But some good things, right? I mean, they talked a little bit about the one thing that was kind of in the back of my mind, which is that $100 million debt payment. And that comes due July 2024. So they talked about that's going to be refinanced. That's kind of a sigh of relief off my back. They are talking about the gross margins increasing. It just seemed very well optimistic. It didn't seem like that they were trying to sell you a bag of used goods, right? Not like a lucid presentation like you guys were talking about on Finance Junkies yesterday. So another stepping stone, but I think it's still a quarter where you're like, okay, wait and see, right? Because you have that anomaly. We know how weather can delay and satellite preparedness can delay launches. So will they actually get 2 launches in the quarter? Will they actually get 22 launches next year? That sort of stuff where you're like, we'll start to see it when we believe it, and actually we'll start to believe it when we actually see it. So to me, it's still another, like, if you're sitting there on the sidelines being like, I don't know, it's like, I don't think that this is going to go belly up today or anything like that. I think they have obviously $300 some million in cash. They have some runway, but there's still some milestones to go, right? And I think that you could wait a quarter or two to see how some of this stuff pans out and get a little bit closer to some of these catalysts and maybe reduce some of that capital exposure risk in the meantime. And it might go up to $5 or $6. In the meantime, the price is sitting here about $450 at the moment, $2.1 billion market cap. It might go up to a $3 billion market cap. Who knows? But I mean, the fact is, if you wait for some of that capital exposure to kind of die down, you're still looking at an opportunity of this being a $20, $30 billion company potentially. I don't think it's going to be $100 billion anytime soon. It's like kind of a different magnitude than a SpaceX at the moment. But, if that's the case, reduce your capital exposure, only get a 7x as opposed to a potential 10x. And who's to say that's actually going to happen, right? So to me, if you can guarantee a couple quarters of lost opportunity cost, but guarantee a 7x as opposed to a 10x, and you're kind of just floundering over some time, then yeah, we'll kind of see. But I think it's going to be very telling once we get to 1Q, what the profitability trend kind of looks like going forward. Because if 1Q looks good and you're able to generate, let's just say, closer to $100 million in EBITDA next year or something like that, then shit, like this thing is probably only going to continue to grow. And if you're trading at $100 million in EBITDA, you're getting close to a price to EBITDA of close to 20, because it's a $2 billion company, $100 million in EBITDA. So, that's where my head is at. It's like, it's the same thing with Dutch Bros right now. Like Dutch Bros is on the pace next year to make close to $200 billion in EBITDA, $200 million in EBITDA, sorry. And it's only trading at a $4 billion market cap. And you're sitting there like, it's not too expensive when you think about it in that respect. So same thing with Celsius that I want to talk about tomorrow. Like, you start looking at Celsius, you're like, it has some potential to triple or quadruple revenues here in the next couple of years. And it's like, their profitability is already pretty good, and their international opportunity is even better. So anyway, I've been chatting for probably a good 30 minutes or so. Any thoughts before we sign off or talk about tomorrow? No. Is there anything in the chat that I missed?
No, I think you covered a lot of Rklb, which is good. I have to do more research. Because it does seem like a very compelling business to look at for the future, for the long term. So yeah, I'll take a look.
And I think that I will be adding shares when I find an opportunity. I have Pepsi still. Fuck. I have so much Pepsi where I'm like, do I actually need Pepsi in my portfolio? Or do I sell half of it, buy Rklb, and take the other half and just buy more S&P 500? Like, I don't know. Anyway.
Verizon, Verizon.
All in on Verizon. I'll sell my 500 shares of SPY and buy Verizon instead. And if I had the opportunity to move my 401k into it, I would as well. No, I'm just kidding. But it would be good for the dividend, though. Can you imagine just like getting that paycheck if you had like 350 grand in Verizon?
Yeah, man.
That'd be what? That'd be close to what? Like 16 grand, 17 grand a year?
Yeah.
Pretty
No.
nice.
Yeah. No, it'd be 20 because it's right now it's 7.5. So
it's 7.5. I don't know why I thought it was like 5, 6. Okay.
Yeah.
Damn.
So 7.5. If at 350,000, multiply that by 0.075, you're looking at 26,250. Divide that up by 12, you're looking at about $2,100 a month in dividend income, and it typically grows about 2% per year. So you multiply that out by 0.02. Actually,
I was out there at one point. Yeah, I think I'm trying to remember when. It's been a year or two since I was like literally chasing dividends. I don't know if last year I ended up at 21 or 24,000, but it was getting to the point where before I started switching the portfolio to be like, why am I only investing in dividends? I was going to be on track for like $28,000 in dividends. And I was like, why at 31 or whatever years old do I need $28,000 in dividends? I was like, I need to invest in growth. So my thought process was this, Chris, like my portfolio yield was like 4% for the entirety of the portfolio. I was like, that's great and all, but I'm like, what am I going to do with $28,000 in dividends? I'm still working.
See, right? the key though with Verizon is the dividend is nice to have, but the importance is the capital appreciation on the underlying stock, because this is what's going to happen. Yields on the 10-year treasury are declining. 2-year treasury, when the Fed starts cutting, a lot of people are going to be yield chasing. They're going to say, hey, listen, I need a fixed guaranteed yield for my X, Y, and Z portfolio that's specifically about dividend income, right? So what they're going to do is they're going to go find companies like Verizon who have ever increasing dividends over time, right? Have stable business, guaranteed cash flows from a lot of clients, and they're growing, and a growing dividend. So you're going to see people bid up Verizon prices, because what happens is that if you look at like the chart of Verizon, what you're going to see is this: you get this double whammy benefit. One, because they're highly levered, any refinancing that they have to do will be at a cheaper price. As deflation comes up and the Fed starts cutting rates, that means that refinancing rates become cheaper, right? So that's number one. That's one benefit. So the cost of capital goes down. Number two, the benefit is the dividend that you have looks a lot more juicier. Imagine right now I said to you, hey, Matt, how would you feel about a 7.5% dividend 2 years ago before the Fed got into its rate hiking cycle? That would be like, holy shit, I'm buying today, right? Today, 100%. That 7.5 doesn't feel that valuable because you could get a 5.5 from the Treasury, but that's not sustainable. Eventually, the Treasury is going to move back down to at least 2%. So
I mean, it's going to be the same spot that we were prior to this cycle, right? Where it was like people were bidding down some of these companies trading at a 20 to 25 PE because they were yielding, mass amount. Think Altria Group, think Pepsi. It's like Pepsi normally before all the zero interest rate policy was trading like a 3.5% yield. And then they bid it down to be 2.5%. Same thing with J&J. There's a laundry list of companies that were trading at like a 3 to 3.5% yield that got bid down just because there was no other place to put money in the market. Like, why would you put it into a treasury yielding 2% when you could have potential for capital appreciation and get that dividend that's slightly better than that 2%. So a lot of people were putting a lot of money into equities, which was part of the reason why the bull market from 2010 to 2020 before we kind of had the pandemic. But that's neither here nor there.
And you can see here, let me just show you real quick. It perfectly correlates. Like when did the rate hiking start?
Early 22. Yeah.
Early 22, right? Look at this. It's been going down since, right? Because like I said, the people are scared of the leverage. They think, oh my God, this company's over leveraged. But you look at their debt, it's a lot of fixed long-term debt. So they don't have much to worry about. Profitability is growing at the same time. So, it's one of those things that it's easy to, this one is, like I said, it's a no-brainer in my opinion. So.
Well, on that note, the question to leave everybody with for ahead of tomorrow when we talk about Carnival and we talked about Celsius, unless Chris has any other ideas, did we or did we not buy shares of Verizon to put into the public portfolio? We will talk about it tomorrow. Not sure if we were going to, I'm not sure how we're going to structure tomorrow. We want to do Carnival first, Celsius first, or if we want to go to the public portfolio first, or if you make everybody wait for the public portfolio at the end. I don't know.
We'll see.
Yeah, we'll see. We'll play it by ear. We'll see what feels right.
Yep.
But cool. Appreciate you staying another half an hour, my friend. And
Anytime,
I'll see you tomorrow.
Take care.
Thanks all.
Bye.